Something just changed. Not the headline price, not the chart pattern every retail trader is staring at. Something underneath all of that. Something structural. The kind of shift that moves quietly through the plumbing of the global financial system. Invisible to most people, unmistakable to those who know where to look. Right now, in a silver market that looks calm on the surface, a signal has appeared. A convergence of physical supply data, institutional positioning, and macroeconomic pressure that has historically preceded some of the most violent, wealth-transferring moves in precious metals history. And if you're watching this before it becomes obvious, you're exactly where you need to be. The signal beneath the surface. Here's what most investors are missing. COMEX registered silver inventory, the physical metal immediately available for delivery against futures contracts, has been declining, not dramatically. Not in a way that triggers mainstream headlines, quietly, persistently. Week after week, the number compresses, while open interest in silver paper contracts remains stubbornly elevated. That combination is a pressure gauge, fewer real ounces, more paper claims on those ounces. The ratio between them, what analysts call the inventory to open interest tension, is coiling like a spring under increasing load. And the spring has been coiling for a long time. The Silver Institute's most recent global supply-demand data confirms what that pressure gauge is already telling you. The silver market has now run a structural supply deficit for 4 consecutive years. Global demand is outpacing mine supply. Industrial consumption alone, solar panels, electric vehicles, advanced semiconductors, is absorbing silver at a pace this market has genuinely never seen before. 4 consecutive years of deficit, and the mainstream financial press is still treating silver like a sleepy commodity that moves when the dollar dips. That disconnect between physical reality and market narrative is where opportunity lives. And right now, that disconnect is wider than it has been in years. What most people get wrong here is the fundamental mistake most retail investors make with silver. They try to understand it as one thing. It is not one thing. It is 3 things simultaneously. And that triple identity is exactly why it's so consistently mispriced, and why when it finally moves, it moves with a force that catches almost everyone off guard. Silver is a monetary metal. 6,000 years of human history have used it as real money, as a hard constraint on governments that wanted to spend beyond their means. Every major civilization that debased its currency paid the price, and every time hard money reasserted itself, silver was part of that reassertion. Silver is an industrial metal, the most electrically conductive element on the periodic table, genuinely irreplaceable in the technologies the 21st century is being constructed on: solar energy, electric vehicles, AI computing infrastructure, military-grade electronics, not interchangeable, not substitutable at scale, irreplaceable. And silver is the most under-owned monetary asset in the developed world relative to its actual physical scarcity. The amount of above-ground investment-grade silver available today is smaller, measured in dollar terms, than almost any other major asset class. The entire global silver market is a rounding error compared to equities, bonds, or real estate. That combination, monetary store of value, industrial necessity, extreme scarcity, is unlike anything else in the investment universe. And when the market finally begins pricing all 3 dimensions simultaneously, the repricing is not gradual. It is sudden, it is violent. And it rewards the people who understood the thesis before the crowd arrived. The macro architecture now pull back further, because the silver signal does not exist in isolation. It exists inside a macroeconomic architecture that provides the most powerful tailwind this asset has ever had. The United States federal debt has crossed $34 trillion and continues growing by approximately $1 trillion every 90 days. The annual interest cost on that debt has now surpassed the entire U.S. defense budget, making debt service the single largest expenditure in the federal government's budget. Sit with that for a moment. The most powerful government in human history is now spending more money paying interest on past decisions than it spends on its own military defense. That is not a political observation. That is an accounting reality. And it carries consequences that flow through every dollar-denominated asset in the world. The Federal Reserve sits in a bind with no clean exit. Raise rates to fight inflation, and the federal debt spiral accelerates, threatening fiscal stability. Cut rates to ease the debt burden, and inflation returns, destroying purchasing power for every household in America. There is no comfortable path between those 2 outcomes. In every previous era where monetary systems faced this kind of structural stress, hard assets won. Not because precious metals investors were pessimists, because they understood the math. And the math, across 5,000 years of monetary history, has never changed. When paper credibility erodes, real things hold value. The industrial demand revolution. Here is the dimension of this story that separates the current silver setup from every cycle that came before it. The energy transition is not a political slogan. It is a capital allocation event of historic proportions. and silver is embedded in its physical infrastructure at every level. Every solar panel manufactured today requires approximately 20 grams of silver. Global solar installations are growing exponentially. The International Energy Agency projects that solar capacity must triple over the next decade to meet decarbonization targets. That is not a marginal increase in silver demand. That is a structural, policy-mandated, multi-decade demand engine that does not turn off when interest rates change or when recession fears spike. Electric vehicle production requires silver and battery management systems, charging infrastructure, and onboard electronics. The global EV fleet is projected to grow from roughly 40 million vehicles today to over 300 million by 2035. Every single one of those vehicles carries silver. And then there is artificial intelligence, the defining technological build-out of this decade. AI infrastructure requires massive data centers. Those data centers require enormous amounts of electricity. That electricity will increasingly come from solar and grid-scale renewable sources. Silver sits at the intersection of every layer of that supply chain. This is secular demand, not cyclical, not rate-sensitive, not reversible. It is driven by policy mandates, technology necessity, and geopolitical competition simultaneously. And it is colliding with a supply picture that cannot respond fast enough, or at all. The supply wall silver cannot simply manufacture more of itself. The mining industry spent the better part of a decade, from 2013 through roughly 2020, in a capital starvation cycle. Silver prices were suppressed, exploration budgets were slashed, new mine development was shelved, the pipelines for future production were left to atrophy. Building a mine from discovery to first production takes 8 to 15 years. The investment decisions that were not made in 2015 cannot be corrected in 2025. The ore that was not explored for in 2014 cannot be extracted in 2024. There is a physical time delay between investment and production that the market chronically underestimates. Meanwhile, approximately 70% of all silver mined globally comes as a byproduct of copper, zinc, and lead operations. Silver is not the primary target, it is the passenger. It cannot accelerate independently. It cannot respond to its own price signals the way a primary commodity can. The result is a supply picture that is structurally unable to meet the demand revolution that is already underway. Not next year, now, today. The deficit is real, it is documented, and it is deepening. That is the physical foundation beneath this signal. And physical foundations, unlike financial narratives, do not disappear when sentiment shifts. Smart money moves quietly. Now here's what the professionals are doing while retail investors debate whether to wait for a better entry. Central banks around the world have been purchasing gold at the fastest pace in recorded history. 2 consecutive years of record accumulation. These are sovereigns, governments, the entities that print the currency and set the rates, and they are quietly, methodically converting paper reserves into hard metal. That decision does not happen by accident. It happens because the people who manage sovereign balance sheets have looked at the global monetary architecture and concluded that hard assets are a better store of value than dollar-denominated paper in the environment they expect ahead. Gold moves first. Silver follows, and when silver follows a major gold move, it tends to close the gap with extraordinary speed and magnitude. The gold-to-silver ratio remains historically elevated. Silver, relative to gold, is still deeply undervalued by any long-term mean reversion standard. Every time in modern financial history that ratio has reached these extremes and then normalized, silver has delivered returns that made early holders extraordinarily wealthy and late observers deeply regretful. In options markets, sophisticated participants have been building call positions at silver price levels that would only make economic sense if a significant upside move is anticipated over the next 12 to 18 months. These are not retail speculators. These are hedged, analytical, long-horizon capital allocators who have done the fundamental work and made a quiet decision. They are not announcing it. They never do. They simply act, and they act before the story becomes obvious, because when the story becomes obvious, the easy money is already gone. The honest side of this, let me be direct about the risks, because a thesis presented without its vulnerabilities is not a thesis. It's a pitch, and you deserve the complete picture. Silver is genuinely, uncomfortably volatile. It can fall 30% in a matter of weeks. It has done so at moments when the fundamental case looked equally compelling. The 2011 crash from $49 to $26 remains a painful reminder that being right about the long-term thesis does not protect you from brutal short-term drawdowns. Silver is sensitive to dollar strength. If the Federal Reserve is forced into renewed rate hikes, if inflation data reasserts itself unexpectedly, a stronger dollar can push silver lower even as the structural deficit deepens. The paper market can maintain its divergence from physical reality longer than most models project. And the industrial demand thesis, while structurally compelling, is not immune to disruption. A significant global recession would soften industrial consumption. Technological substitution, while unlikely at scale, is not theoretically impossible. Policy reversals and energy transition funding could slow solar deployment timelines. These risks are real. They deserve honest weight. But here is what the risk-reward framework ultimately requires you to assess. Not whether risk exists, it always does, but whether the magnitude and probability of the upside justifies the exposure relative to the downside. And when you align 4 consecutive years of structural deficit, irreplaceable industrial demand, constrained mine supply, institutional accumulation, monetary system stress, and historically compressed valuation relative to gold, the case for asymmetric upside is not subtle. It is direct, it is documented, and it is being quietly acted upon by the most analytically rigorous capital in the world. What comes next? Imagine you are sitting here 18 months from now. The Federal Reserve has been forced to choose between fighting inflation and managing the debt burden, and the choice it makes sends a shockwave through dollar credibility. Central bank gold purchases accelerate further. The mainstream financial press, which ignored silver for 3 years, suddenly produces a cover story about the silver shortage. Retail flows flood in. The paper-to-physical tension on COMEX reaches a breaking point that forces a structural repricing. The gold-to-silver ratio compresses violently as silver closes a decade of relative underperformance in a matter of months. The investors who positioned before that moment, quietly, patiently, while the market was sideways and boring, are not surprised. They understood the thesis, they held through the frustration, and they are now watching their positioning validate everything the data was already telling them. The investors who waited for confirmation, who needed the price to prove the thesis before they acted, are chasing. They're buying strength instead of value. They are the exit liquidity for the people who arrived early. That is not a fantasy scenario. That is the historically consistent pattern of how structural commodity repricing events unfold, every single time. The question that remains here is where I leave you. History does not reward the most intelligent investors. It rewards the most patient ones, the ones whose conviction is rooted deep enough in fundamental understanding that short-term price noise cannot shake them loose from a thesis that the data continues to confirm. The silver signal that appeared is not a trade alert, it is a structural marker, a point on the timeline where the physical reality of supply and demand, the monetary reality of debt and dollar credibility, and the industrial reality of technological demand have converged in a way that the market has not yet fully priced. That window between when the signal appears and when the market prices it is the only window that matters. And you are inside it right now. So I want to ask you directly, and I want you to answer honestly in the comments below. Are you holding silver right now? Are you building a position slowly and methodically? Or are you still waiting for the price to prove what the fundamentals are already saying? Because in 10 years, when this moment in monetary history has a name and analysts are explaining what the signals were and when they appeared, the only question that will matter is which side of that window you were standing on. Drop accumulating or watching in the comments. I read every single one.